Hi, thanks for joining us again. Today I want to talk a little bit about testing and the different testing tools which are available in Optuma. Now, obviously, we all know about backtesting. One of the first things we learn about is, let's backtest this idea. There are so many considerations that have to be made when we do testing. Now, I've actually done a full hour-long webinar on testing and some of the pitfalls of testing. You can see the link there below. Go check that out. If this is something that you want to do and you want to create strategies and you're relying on testing, it is critical that you understand all the implications that go along with testing. Because one of the biggest things that we hear is people who say, I tested this, but then when I went to actually trade it, it never happened. Well, there's a lot of reasons why. And so do go and watch that video as well. All I want to do here in this short video is just give you a quick little look at the tools that we have and what they do and how you can set them up. But obviously, testing is a really advanced topic. Now, again, depending on which version of Optuma you have, you may not have all these tools because they are such advanced tools. We include them in our higher priced editions, but they are available for purchase on a standalone basis as well. So what we're going to do is come to the searches menu and let's go to the backtester. This is the most common one that people use. So I can come along here and say, right, let's create a new test. And I've got my entry criteria, I've got my exit criteria. So maybe what I want to do here is say, let's create a new scan here, and I want to have an entry criteria for when the RSI, and let's just make sure that's a 14 period, so it's a little bit slower, crosses below the 30% line. So that's going to be my entry condition. And then I can come along here and say, right, now let's have an exit condition. And I want to exit when the RSI, I should have copied it from the other one. And again, let's make it 14. It doesn't have to be the same. I could have a 10 period RSI here. So I've got a faster RSI for getting out. And I can say crosses above the, actually, you know what I'm going to do? I'm going to make this crosses below, but I'm going to make it a higher value, because one of the things that I feel is that often with an RSI, we're hitting that upper band and the market's still going up. It's only when it comes and crosses back down that we should be looking to exit. I'll make that 70. Where are we? 70. So RSI crosses below 70 is going to be my exit. And then I can add stops and targets in there as well. Right, so the test types, I've got two types of tests. I can do a signal test, which is what we're building here, or I can do a rebalance test, which is more along the lines of order all of these securities, because I have to have a position in 15 of them and then take the top 15 based on this condition, based on their market cap or their performance or whatever it may be. So you can set that up. Obviously, we're doing multiple codes, and we're testing on the S&P 500 again. I'll just leave it there. Membership is current. Now, we do have survivorship bias for S&P and the ASX. Again, I explain all of that in the video. Survivorship bias is one of the key reasons why tests are overly inflated when we look at them. If you don't have survivorship bias data for the market that you're testing, make sure you take off between 3 to 5% of the results, of the returns, I should say. All right, date range. We can do any sort of date range. Now, one of the things that we talk about when we do quantitative testing is having like a workbench set of data. So I've got this set of data from 2001, 2009. It's a fairly flat market because the market ended where it started, but it's this long period of time. So I like using that because by using that same period of time over and over again, I get to really have this good feel about, okay, well, this result's significant. And then I can then bring that forward and do some more walk forward analysis as well. But that's usually where I start. But for now, I'm just going to say last 5 years. Terrible idea for doing comparison testing, just to say last 5 years, but I'm just using it now as an example. Using daily data, comparison code, I want to compare my analysis against the S&P 500. Interest rates, that's for doing Sharpe ratio and things like that. We're sitting at 1%. Now I've got some test rules that I've got to look at. When am I going to enter? Am I going to enter on the day that I get the signal? Or is it usually going to be, signal day close, or is it going to be the next day? Normally, when I'm doing end of day data analysis, it's going to be the next day that I enter. So that's what we try to do there. Position sizing is fixed. Let's just make that equity percent, and I'm going to do 5% per trade with a maximum of 20 positions in my portfolio there. Brokerage model, I can put brokerage in here. Pyramiding trades, if I get more than one buy signal in a row, am I going to take more positions in that one security? So I'm going to say no to that. Scale in, scale out. Some of our institutional clients take a number of days to scale into a position because they don't want to move the market with the volumes that they're buying. So we have this where you can say, okay, I'm going to take 5 days to scale into this position. What does that do to my returns? Minimum hold days. If I'm buying, then I'm not going to sell for at least 15 days, because particularly when you do things like moving average signals, you may be getting a lot of chop at the bottom of the market or at the top of the market, and your experience may tell you, well, after 15 days, it comes good. So I'm not going to get out for the first 15 days. All this control is to give you the ability to customize this to suit your individual needs. Again, max hold days. What's the maximum? That if I get to 180 days, 6 months, that's it, I'm out. I've done more than enough, and I don't believe this is worth holding any longer. And then close all positions at the end. Monte Carlo we'll talk about in a moment. And then what's my initial balance and how much am I willing to risk? So then we can come along and say, right, let's test the strategy. So what's happening now is Optuma's opening up each one of those codes, finding all of those signals, collating them all in date order, all of those signals, and then running through and building a whole equity model and tracing all of that. So what I can see, and let's just make this a little bit bigger. When I get my results, what I've got here is the red line is my comparison code. So that's what the S&P did over the last 5 years. This is what my strategy did. So you can see it's not very good. Now the blue is my equity. So it's the total of my cash and my stock positions. The yellow is my cash. So it's very interesting. There's some periods where we really go back to cash quite a bit in this one. But I can see, how that's performing as well. Then this chart here is our underwater graph. So basically what it's saying is from the most recent peak, how far have I gone down? What's my drawdown been on this strategy? And I can see that, right down here, I'm underwater about 20. And then all the way down here, I get down to nearly 40% being underwater. So terrible idea. Don't use an RSI like the way I just set up. Then we've got profit analysis. We take each individual trade and we plot, okay, what was the profit on that trade? And so we can see here, this line is break even here. And I can see that I've got so many losing trades here, but then I do have a bulk of winners. So I look at that and say, oh, hang on, maybe if I cap out and add a stop at 29% and get rid of all of that, maybe there is something here that's worth looking at. So you can see that we can do that sort of work as well. And I can bring this up here as well and see what lift that would give. So very, very quick and easy. Monthly returns, just looking at the individual months and were they positive, dark green, were they really negative? So obviously in March and February and January this year of 2020, we had a number of bad months there, but coming good in April again. So we've got all of that data there and we can look at that. Now coming down here, we can see how many trades were made, our annualized returns. So over the 5 years, how much did we make on an annualized basis, factoring in compounding? Annualized volatility. So what was the volatility of our returns? On a monthly basis, all of that's calculated. The beta, the compounding annual growth rate, you see that mentioned quite a bit. That's really just taking the start and the end and dividing by a compounding factor. Annualized returns is a much more accurate figure than that, but it is mentioned quite a bit. Sharpe ratio, which is the returns over the volatility. Maximum drawdown, longest recovery time. So that's the time from one of these dips in our drawdown. What's the maximum amount of time before we recovered from that? And it was 1 year, 1 month. Trading expectancy, we'll talk more about that in the quant course. And then we have all of the index results. Because again, I'm looking at this from the perspective of, does my strategy beat a buy and hold index fund? Because if it doesn't, then why am I trading this idea? And so we have those. Now that's a summary. The report then goes into a lot more detail with a lot more metrics there, breakup of short sales versus long if it's a long short strategy, and working there. The trade list, the individual trades that were made, when they were made, whether it was profitable or a loss. So you can see all of that, and you can export that. You can see in the actions down here, you can export those to CSV if you want as well. Final one is Monte Carlo. Now this one takes a little while. So let me just start this button. That's why we have it on a separate tab. So the idea behind Monte Carlo is saying, let me randomize the security that I would have bought, the actual start time of my trade, but I want to keep my exposure to the market the same. And so we do that. We randomize everything. We go through the list of trades, we randomize everything. We then go back and measure what our returns would have been, what our probability of gain would have been. And then we take that result and we repeat that number of tests 20,000 times. And then we get these plots. This is getting into null hypothesis and all of that. We talk about that. We have a quant course that we've created where I go into a lot of the theory about testing, about statistics and the types of things you need to know. So if you're interested in that, check that out at learn.optuma.com. But when I look at the Monte Carlo results, what I'm looking for is this barrier between the colors. Ideally, for something like this to be significant, we want to see our result, our change in colors over here. That means that 95% of these observations are over on the left-hand side and 5% are over on the right. That tells us that when I compare my strategy to complete randomness with no decision making at all, just randomly pulling codes out, hey, this is significant. And so from a null hypothesis point of view, we're actually showing that, yes, this is a significant strategy and it's definitely worth trading. And so I want to see that in average returns. What are my returns significant? And I want to see my probability of gain. Is the probability when I go in on that individual trade that I'm going to win, is that significant? So when I look at this is terrible. You may just see the little bit of blue here. It is absolutely terrible. I've got a p-value of 99.97, which is completely wrong. I want to be over here at a p-value of about 1% rather than that. So that's telling us that from a returns basis, our idea of using the RSI is crazy. I would have been better off over that 5-year period just throwing darts at a dartboard. And I would have had probably more probability of getting better returns. From a probability of gain, again, not good at all. This just says it's no better than random. But that's the Monte Carlo tool. We go into a lot more detail. Even the free introductory to the course is worth watching if you're interested in this area. So do check that out. The other part that we talk about in testing, see, I would never start at a back test. I would always start with a signal test, because the signal test works on the premise of saying, I have all of these trades. Now in a back test, I may have 10 trades, but I only take the first one and then I ignore the next 9. But maybe the first one was bad, or maybe the first one was really good and the next 9 were terrible. I want to know what is the performance of every single signal, because then I start getting some confidence that when I see that signal happen in real life, that I can actually trade it. When we look at the properties here, so very similar to the backtester, but there's only one signal that we add here. So we can come along, let's just add that first. I want to use my Optex, where is it? Optex lower. Actually, this time I'm going to do crosses below because I want to use that as our signal. This is without trend. So I'm going to make this condition 1 equals that, and condition 2 equals 01 dot trend. We built that into the tool, is greater than 0. And then I can just say C1 and C2 and hit apply to that. No, I don't want to change that. I want to save that as a new script. All right, so now that we've got our script there, we can come through here. We have 2 types of tests. So we've got the signal test here and a trade test. Now, a trade test would give me an exit criteria. So again, we talk about that in the introduction to quant. All right, comparison index. Again, I'm just going to use the SP500. We're going to do this over multiple codes, and we are going to use our lists. I'm going to use my S&P 500 list here, and it's adding all of those codes there. Current membership, I'm just doing last 10 years. I don't normally do that. Well, maybe I will change this. Let's go to date range, and I'm going to go to 2001, October 1st, and back here to 2009, October 31. All right, so we got a 1-day period. Not going to group. We could group by year if I wanted to break it up into years and things like that. I'm going to leave that. Stratification we'll leave. Periods before, periods after. This is when I get a signal. So remember, what we're doing here is we're finding all of those signals, and then we're measuring all of the returns that come after that signal. And from that point, we're going to average them all up. So what I want to know is, well, what's the average action before the signal, and what happens on average after the signal? So our periods before, normally on something like this, which is a mean reverting trade, I'd only do 10, and maybe here, we'd go out to 3 months or 63 days, 21 trading days in a month. Calculation style, absolute returns. I could do relative returns on that. Comparing against the index, I'm going to show the mean returns. I don't want the high-low plots. And I think we'll just leave everything else there as it is, and we can go test signal. So again, Optuma is going through for all those 500 securities. It is finding every single opportunity within that window of trades that we're looking at, and then measuring what are the returns from the prior to the signal, after the signal, and then combining them all in together. So the first 50% of this process is actually finding the signals and measuring them all. And then the second 50% is Optuma then collating everything together. So we might just cut just to save you time waiting there. All right, so we've got our results there. We can see now what the expectation is over the 63 days or the 3 trading months from our signal. So again, we've got 5,114 results from this period. We can see that from the signal, the average result is 3.6% gain over 3 months. And then we can look at all these numbers here. Probability of gain is 60%. So I've got a 60% probability when I take that trade that it's going to be a profitable trade. And so that's pretty good. 3.7, 80th percentile, standard deviation. We've got those numbers. These plots here, again, we're taking all of the signals and we're putting them into bins. So we're saying, okay, let's take the returns at 4%. And we can see that 96 trades, or 1.8% of them, were exactly 4%. I think the bin size is 0.5% that we have here. Trying to get in between those two. There we go. So yeah, 4.5, etc. So you can see then looking at it saying, oh, what's my expectancy? What do I think that we can get? And you can see that the average here. Now, when I look at this, I want to see that plot skewed off into profit. Then I know that I've got a strategy. It's not reliant on a couple of winners and lots of losers. That's never a strategy to win with. I've got this idea that if I can get it across, then I've got a strategy which it's really robust. And it may not be a great trade, it may not always perform the best, but I'm still going to make decent profits as I go. I can also look at this and say, you know what, maybe we should knock out anything below 30%. At that point, I can get an idea of where my stop is. If I had my stop at 5%, well, I'm going to lose a lot of trades at that as well. So I'd be more inclined looking at that to try and shift it more to the right, rather than trying to put a stop in, because I think I would lose too much money that way. So the yellow line here is the actual returns in the index. So every time we get a signal on whatever date it is, we measure that security. And then we also take a measurement of the comparison index, in this case, the S&P 500. And we measure that. And we say, okay, well, what's its returns like compared to our signal? And so we can see that when we take all of those measurements in the S&P and we average them up, then we get just under 1.2% return compared to our 3.6. So we've got a 2.4% relative performance, which is the red line here, improvement over the benchmark there. So it's telling us that, hey, this is an interesting idea which can give us some good returns there. Signal results, you can go through and look at the individual signals, and you can look at them by code. So we can say, okay, for Apple, we had 23 trades, had a 70% probability of gain, so you can look through that and start to say, hang on, maybe there's a certain sector that this works better for. And you can start deriving different things from that. So that's the signal tester. Obviously with the back tester, they're very powerful components that can help you when you're ready to do that quantitative type work as you go. They are advanced sections of Optuma, so don't worry about trying to use it all now. But all I really wanted to do was show you that it's there, and also give you a little bit of hints about the statistics that we use as technical analysts and how we put all of that together. Hope that's been beneficial. Thank you.